Hi, hi, good afternoon. Can you hear me, Simon?
Yes, I can hear you as well, which is great. So,
Okay.
welcome
Well,
to the webinar.
thank you, Simon, for having me. And no, it wasn't that patient waiting because I quite enjoyed listening to Zahir, and I think he raised some great points. So very good.
He is, he is. Now we met at the London Forex show just in February, and I was quite interested to hear about the well, it's a fund, but you also have software coming through from marketsflow.com. So I'll let you tell people about that and about the strategies. You're talking about a 2% yield month on month using a fairly low risk strategy. So interested to
Yes,
hear about that. What I'm going to do now is going to make you the presenter. So you'll see a dialog box asking you to accept the role of presenter.
okay, great. Thank you, Simon. Can you see my screen?
Yes, we can. We are looking at the first slide. You might want to maximize it because we're looking at the preview of the slides on the left as well.
Right. Okay. So I think I've got a few screens. I'm not sure which screen is the one you're looking
We're
at.
we're looking at we can see your mouse going around.
Okay. So can you so you can see the screen where you can see all the slides, can you?
Yes, but I can't when you're hitting on the maximize the screen show button, it's not
The
it's
thing is, it's maximized, but it's done that on another screen, and that's I mean, not sure how I can how I
maybe you
can.
can just if you can pull it across from the if you can sort of touch the top of the window,
Uh,
you can pull it across onto that screen.
oh,
But if
oh,
you
I
can't,
see.
you don't need
Okay,
to.
1 second then. Right. Okay. Yeah, I'm afraid I can't. It seems to be so. Simon, what can you see? Oh, right. Can you see? Can you see part of my screen, or can you see the complete
Well, we
screen?
can see we can see the slide. I think we'll just be okay to run with this if you're happy to run with that. I think it's absolutely fine.
Sure. Okay.
To see. So, how to receive up to 2% yield per month using a risk-averse strategy. Tom
Well,
Nash, I'll hand over to you.
thank you, Simon. Thank you. And yeah, that is an interesting title, isn't it? I mean, most people in um, the investment management world try to steer away from numbers. So they'll talk about trades. They'll talk about the winning trades. Generally, not talk about the losing trades. But generally, in 9 out of 10 times, they will not stick to a figure. It just it's too difficult, and most people don't. Now, I come in from the context that I think investment or trading is very much about data, and it's about numbers. And if you can somehow master the art of numbers, you can try and define your whatever outcomes you look to achieve from a market, as long as they're realistic. So just maybe going back to what Zahir was mentioning on the three books he talked about, the reminiscence of the stock operator. He talked about Nicholas Dervish, how I made 2 million out of the market, the turtle trader. The one thing there about Nicholas Dervish, or most people, including Dan Zanger, who has the record for the most compounded returns in any year, is that most of these guys did well in the early bull stages of the market. So in early bull stages, the market works very differently than it works in other cycles. What I mean by that is the sector rotation is not as vicious. So every sector generally is in a bullish mode. Whereas as you move through different cycles, the sector rotation becomes far more prevalent, and it's more difficult to be on the right sector at the right time. So anyway, that doesn't really link to the 2%, but I'll move on to it. So anyway, thank you. Good morning and good afternoon to everybody from the US and from the UK. I am the CEO of MarketsFlow. We have built, in fact, one of the most advanced machine learning AI-based portfolio management tool, which does asset allocation and active portfolio management. Now, it's primarily built for the professional investor, i.e. institutions, but also we are looking at marketing it to the retail, albeit getting all the right permissions from FCA and so on. However, one of the other things we do is that we also run workshops in London where we talk about how to run a high-performance portfolio. Now, I want to stress something about the portfolio. There is a difference in having great trades. However, if your portfolio isn't moving forward or isn't in sync, then you know the individual trades really don't mean much. So you could have 2 great trades, you could have 6 bad trades, and whatever. The ultimate test of a portfolio is how well it's you know, moving forward with minimum volatility, and ideally you want to keep your maximum drawdown levels minimum, because that there's a lot to talk about liquidity and so on. But anyway, I won't bore you, and I'll get it straight into how we achieve the 2%. So, right, Simon, you can see, I think, the screen as I flip.
Yes.
Okay.
Yeah. What do we want to get out of this?
Right, exactly. So what do we want to get out of this? We want to make this complex message as simple, fun, and exciting, and I want to inspire you to do it. I have a number of other people who also use the same strategy. They are clients, and we have some hedge funds and some other people, and generally, once you understand this, you'd probably not be seeing the market the same way as you did. It puts a different spin onto the market. And I might add, which I wanted to add later on, that some of the most efficient players in the asset management world, which are the hedge funds, including Warren Buffett, or you name it, Bill Ackman, and some of the others, use this same strategy quite intensively. In fact, it is married into their investment. So, right, so a little bit about me, which I'm going to talk about. I'm also going to briefly touch on retail, what the difference between a retail and a professional investor is, and I'm going to talk about options to generate the 2% yield, which is a very attractive title on the slide. We'll see a few examples, and then we will have Q&A. So my corporate background is with JP Morgan within the capital markets. I've dealt with various asset classes, from bonds to equities to other. I wasn't necessarily trading with them, but I was dealing with all other aspects of the asset management. But I have had a career outside JP Morgan as well, having founded a business and then sold. My special focus or area of focus is data mining, machine learning, artificial intelligence, and quantitative data analysis. I very much look at the price action in the market from a data perspective, and I like to see patterns, and within those patterns, I like to make sense. And I believe most traders at least attempt to do that when they're doing technical analysis, or to some extent they try to fit fundamental analysis within the technical analysis. But what I do within the quantitative element is that I take it further, where we look at any sector down to the security level within that sector, and we look for patterns within leaders, laggards, and the sideways movements. It is interesting when you start to look at things that way, that you see that the market is not necessarily an efficient machine. So when you think a particular security might, or a stock may be going up, it starts to behave differently. But when you look at the overall sort of analysis or breakdown, it may make sense that a particular security probably was 5% up last week, so clearly it's not going to be 5% up the next week, whereas that movement may be passed on to its peer. So anyway, things like that. I also look at active strategies, and I also talk on panels where I'm referring to machine learning as a tool used for active strategies or active portfolio management. I led the development of our in-house tool, which has won awards in New York, and now it's been nominated in Europe for 6 categories, including the best portfolio management tool and so on. I also like to look at smart beta, so we are looking for stocks or securities which have higher beta but are but low volatility, and the key there is a cycle or a stock may go out of fashion. So this is relative, but we are trying to identify smart beta stocks at any given time. And finally, I use options heavily in building, running, and managing a portfolio. Now, a portfolio may include stocks, but we marry the function of options along with stocks. So, I mean, I try to explain what a difference between retail and professional investor is, and I think it's difficult to pinpoint. So I think pictures speak 1,000 words. A retail investor may be flying a Cessna, and a professional investor generally is flying a Dreamliner. So that clearly means they have far many levers compared to a retail investor, and we're going to talk about one of those levers, which generally a retail investor is not aware of or doesn't apply in their strategy, and that is the options. And we're going to talk about a specific function within options as well. Again, very few of the investors actually touch upon that particular aspect of the options, the risk-aversive side of the option writing. So how do we get 0.5 to 2% yields per month? It is not that difficult if you break it down from a data perspective. So here we just have a simple example which may be which may make sense or may be difficult to grasp at the first outset. So let's take the example of Apple as a stock. You currently don't own it. And don't worry if you don't understand the whole strategy, because clearly investing is about a journey. As Zahir touched upon, you've got to learn it. You've got to learn the tools, and you've got to be comfortable, and you ought to know when to apply those tools. But if you just bear with me and just try to follow through this example, let's say at the start of a month, you are looking at Apple. You don't own it, so the first week, all you do is you write a put option on it, and let's say Apple currently, I don't know what, 140 or so it's trading at. Let's take the live example. So I'm interested in taking a position in Apple, and I will write a put option on that, and I will get instantly 0.5% onto my account. So here I've received a yield. Now I have not bought the Apple stock, but I've just written an option. So that's week 1, and it's currently, let's say, trading at 145. I write an option that if it falls by Friday, and today is today is Thursday, but let's say it falls tomorrow by to 140, I will get assigned. In other words, I'll buy. If not, I'll just simply get 0.5%, and that gets deposited to my account irrespective of whether I get assigned or not. So there we go with the 0.5%. Let's move on to next week. Now Apple did fall below 140, and we did get assigned, and that's fine because I wanted to buy Apple anyway, but I've got now 0.5% sitting in my account. Now, if you move down, look at the lower part of the slide. Now I own Apple. So it's week 2, and clearly Apple has fallen, being a strong stock, or I had done my analysis using my quantitative data models. It pushes up. It closed on Friday at 139.70. Next week, on Wednesday, it's trading at 143. I write another covered call on that 143, which expires on Friday, and that call was for 145, let's say, and I get assigned, or I get deposited a premium of 0.75% on week 2. Now, week 2 ending, Apple doesn't go above 145. It kind of stays in the range of 143. So I get to keep that 0.75% and I get to keep the stock. Now, week 3, it so happens that there isn't a clear opportunity, so I don't do anything. Now, generally, if you apply this strategy properly, you potentially are writing the complete 4 weeks, either a put option or a call option. But let's say we didn't have that opportunity, so moving on to the 4th week, the stock has now moved up to 143, and I might write another covered call on the 4th week at 145 again, and I get paid a premium of 0.75% for that week, which is a covered call. And the stock now at the end of the month either moves above 145 or it stays below. Irrespective of that, I get to keep my 2%. But if it were to move above 145, I get assigned, in which case I've made capital appreciation from 140 to 145, but on top of that, I've actually picked up 2%. Now, you can have more than 2%, you can have less than 0.5%, but generally every time you write an option, you get to receive something. So this is very different than actually trading. So therefore, I've put the title as achieve 0.5% to 2%. But you know, the better you get at it, the better you can achieve in terms of the yields. But there are caveats which we'll talk about next. But I hope this gives you an understanding of how you achieve that, and now we're going to look at some of the examples. So use options to enhance performance. You're doing a cash secured put writing. You're generating income. You're supplementing that income, which adds liquidity to your portfolio. It's a risk aversive strategy because you've decided to write options on something you were going to buy. But more importantly, you get to keep that stock. Now, if you're clever, as many a times most people who use this strategy, the most of the time, which is about 70%, they are not assigned. So they are simply collecting premiums. And you've got money in the bank, and you're simply collecting premiums of 0.5% to 2% per year. Now, there is some element of looking at the market at any given time. You may want to look at the market, and if the market, as Zahir put it, is in a consolidation mode, the best thing there is to simply be picking up premiums and not necessarily getting assigned. However, if you're in a bullish cycle, you may be looking to get assigned and looking to get further premiums on your covered calls. So there are many benefits to this strategy. One of them is that by using this, you can discount buy your stocks. You can apply your cost averaging to your price buying, and we're going to look at an example where we applied this last year. I have some live examples as well for the last month, but you can just look at an example of a particular stock. Now, this is a high beta stock, and generally for risk-aversive people, and to some extent I fall into that as well, I'm generally dealing with low beta stocks, but this particular one is a high beta one. And if you look at the month, sort of from July 2016 to October 2016, we had 2 put options written on it, and the average compounded return on that using the options was about 118%. So you can see, you know, it's not just simply 0.5% to 2%. In this case, this being a high beta stock, we picked up 5.33% on one of the put options, and on another 34.21%. I believe we sold this stock using a covered call, and I think we received another 30%. So overall, we had a compounded return on that of about 200% or so. So and that's the power of options. But if we had just looked at the stock alone, I think it was up about 25% or so. So on the covered call side, so that was the put option. That is where you have no position, but you're using the power of put options to achieve that income of 0.5 to 2%. On the covered side, or the writing options on securities you hold. So if you have decided to build your portfolio of 4 stocks, you might as well be looking to apply put strategies at the outset in terms of buying those securities. But once you hold them, you can also then generate income by writing covered calls on those stocks. So that's how you generate income on the covered call side. Clearly that supplements your capital appreciation, any dividend income you might be receiving. It creates liquidity. What that means is every time you've written a covered call or a put option, you get that money added to your account. So what that means is you've got more money to trade. And in the business of investment management, liquidity goes a long way. It is risk aversive because you are getting that guaranteed without speculating. The only speculation you're doing is at the outset what security you're going to be writing your options on, which anyways is the case whether you're buying stocks or not. It also, one of the things with covered calls is that most traders, or let's say in the early days, there is a big difference between unrealized profits and realized profits. By applying this strategy, you actually realize profits. So most people sometimes just hold on to gains with the view that this stock is going to go to the roof. And the problem with that is that that is perfectly fine as long as they knew the market maker, and that was the case. Most stocks don't go up in a straight line, up or down. So what you end up is that you may be having profits, and then within 3 months the market changes, and all of a sudden you're back to break even. By applying this strategy, at least you're systematically taking profit. So it's also a very clean way of running a portfolio. We'll look at this example. So there is a stock which we were heavily invested in, and this stock was literally going up and up, just like one of those stocks which goes to the roof. And I think it probably went 400 or 500% up last year. But we held this, and we achieved, I think we achieved about 22% on that stock, but we wrote covered calls on it. And you can see here 2%, 1%, 1.98, 1.98, and 2.25 on a put. So there was a mix of writing put options as well as covered calls on it, and total realized gain was about 32%, and again analyzed 193 and 59.36. But I think the key here was that we weren't just simply holding on to a position which was rising in value. We were collecting premiums, and then our account was growing whilst we hadn't realized the profits. So I'm not sure you can see this screen, but this is current positions on some of the options we've written, and this is from a live account using our own platform. So if you look at I mean, you can't see the exact. Yeah.
Sorry. Yeah, the numbers are actually a little bit small for us to read.
Okay.
Some people might have difficulty, so you might want to just repeat.
Okay.
Read them out if you may.
Read them out. Yes, I'm sorry. I'm not sure how I can magnify, unless I could magnify this. Can you see that better?
Yeah, it's a little bit better. Thank you.
Okay. Well, the power of magnifying, or compounded. Right. Okay. So the first trade is NVIDIA, which has been a hot stock last year. So here we go. I mean, it's important to look at this risk aversive strategy. So last year was a great run for NVIDIA. If you were on the right side, brilliant. 400% or whatever, 200%. I mean, somewhere around 250 to 400%. If you could have known where to pick the bottom and where to pick the top, it's a totally different story this year. It's far more volatile along with AMD. So all of a sudden, the people who were very much on the right side may well be on the wrong side this year. However, if you were applying options, you didn't care about that. So we actually have an example here, and this trade was taken starting on 24th of March. It was taken on NVIDIA with a put option, and we have a $50 on this, and I believe it may have been a one contract. So one contract means $10,000. On $10,000, $50 were assigned to the account on the 24th. I don't believe the NVIDIA was called. So in other words, we simply took the premium. On the second trade, where NVIDIA had fallen about 7 or 8%, we wrote another option. In fact, this time we wrote two contracts, which is worth about 22,000 or whatever. But each contract is about 100 shares. NVIDIA trading at about 105 or so. So for that particular option, put option, we received $279, which is about on a 20,000. That's roughly what about 1.3% or so. This NVIDIA option was actually assigned. So we can see on top NVIDIA stock assigned at 102. But if you move up to JPM, there was another option. So this is actually a month course, which I purposely put together to prove how you can actually do that. And we're doing this in a low beta environment with some of the best securities, which really have the lowest volatility. So JPM, an option was written for two contracts, and again we got 93.75, which I believe is about 1%. We wrote a put option on Tesla, and we received about 109. Now Tesla is an expensive stock, so that was about $30,000, and we received about $109. I think the key here is, all we're looking at is if we cross a month using this strategy and it's 2%, we're quite happy. That's about 24%, leaving aside any capital appreciation. So on that option we wrote, which was the NVIDIA, with the two options at $279, which we received. That option was assigned, and we purchased NVIDIA at $102 on the 10th of April. Now, as you know, currently at the moment, NVIDIA is trading at about 105. So already on that trade alone, we have about I think $400, $500 profit. On that profit this week, we wrote another two covered calls, and we received $189. Now, you can see how this is working. So if we are to, so within a month, using roughly about $20,000 to $30,000, we've actually achieved about $1,000 looking at these numbers and looking at NVIDIA today. Now, NVIDIA position, if on Friday it expires above 105, we are going to get assigned. But it doesn't matter. If it happens, it's great. Next week is NVIDIA's earnings, and we don't trade events. We're not in. Our system is not designed to work with earnings, because that is a gamble, and this system is designed for non-speculative stuff. So there we go with a live example. Moving forward, in terms of our investor education, this is really what we teach. I think what I've covered is the skeleton of how you would apply that strategy. But I think ultimately knowing when to write an option and how to do it, what stocks to be looking at, what underlying securities to be designing or packaging this. We cover that, cover the whole thing in a day, and we also talk about sort of what performance means of a portfolio. We go through the liquidity and how you can use liquidity to build your portfolio. We also look at the planning, building, and executing of a portfolio. So I have some details of the course which are also on the website, but essentially we cover things like equity portfolio management, the investing psychology and behavior. We cover money management, position sizing and hedging. We cover options. We cover the planning of the options for using a portfolio. We look at how options help in that performance or the extra yields you're looking at. We also then look at the perfect match of equity options, when to use equities or when to use options. We look at quantitative tools and strategies which help us build that performance. We look at the build-up, execution, and post-process, and we look at live demos on the day of particular options which may be suitable on the day. At any given day, you could write options, or you could write covered calls. We have our workshop happening on the May 5th. We also have one on the May 19th. The cost is $395, but I spoke with Simon and I think we're going to be generous. So if any of you want to attend that live, it'll be £245, and if you want to attend that through a webinar, it'll be $145, and I believe we'll do the conversion into dollars on today's rate, and it's 1.28 or something like that. But that for the American audience. That's it for this presentation. Ask me any questions you may have regarding this. You may well be familiar with this strategy, or you may have heard about it, or you may have explored. Now, there isn't a lot of information about this online for good reason. So you know, let me know what you think about it, how it fits into your current strategies, or if you've generally got questions. I hope you'll be feeling a little bit relieved that it sounded too good to be true. This is one of those things. It actually is. I think the too good bit is knowing when to do on what security. Simon?
Thanks, Tom. It's Simon here.
Sure.
So it seems like a clever system. We're talking about options here, and we're talking about the premium of the option and the choice that the options provide you to either take the trades or not. So is it something that you've been trading yourself personally? Have you been an options trader that's allowed you to develop the system?
Yes, I have been. In fact, like most of the people on the call, and pretty much most traders out there, trading is a war, and the strategies change from all aspects. So what options does is that it brings some normality into the whole experience. And before, I was very much sort of going gung-ho, looking at technical analysis and taking a position. Whereas now that bit, it just goes away. So all you're doing is, on any given day, you've decided to do something, and I don't sit in front of the screens. And it's most people who are there in the long run, or have compoundedly built their portfolios, are generally not looking at the screens 24/7, looking to catch the fish. It is not a healthy way, and not only that, you are not the market maker's friend. So you have no idea to try and put a spin on where you think things are going, because nobody can call the market. You can certainly follow the market, you can certainly be reactive to it, and options gives you the best way to actually be risk aversive and be following the market by applying that strategy. You have to get good at it, and you have to learn it. But yes, that's my experience, and as I said, most hedge funds use it. Most good hedge funds use it. The ones at the top apply this strategy, building the positions and on all the positions they hold.
Richard's asking a good question on the sort of the detail of applying this system. How much money does one need to have with a broker for the security for us to write options, enabling us to do this system?
Richard, that's a very good question. So that's down to because this is designed ideally for a professional investor or an investor who doesn't want to speculate, who doesn't want to gamble with the markets as trading can be at times. So in the US, a contract is 100 shares, so minimum 100 shares. So look at any price. Ideally, what you want to do is you want to be looking at 2 to 3 contracts of a particular share. So my suggestion here would be to go low beta, good quality stocks, and that's what we trade in. And good trading stocks are generally, for 100 shares, are between 8,000 to about 25,000 or so. So what I say is that, you know, around $30,000 is a good start. You could start off with 2,000 as well, but the problem with 2,000 is you're going to find poor stocks at you know, 100 stocks. Or you could start with 10,000, then you'll simply be having one contract. But I think if you have something like 30,000, I think you're in a great position. And I'm not going to use words like your account is going to disappear or anything, because, you know, this is not. In fact, if anything, your account doesn't disappear writing options. All you do not see things like you know, you get guaranteed income and you're working within a range.
Thank you. Is there any limitation in terms of what companies you can write the options on? Do they have to be American companies, or is there? I think there's more choice certainly in the US markets.
Well,
do you operate in the UK as well?
Again, a great question, because Americans lead the world in option writing and options. It's just bizarre, because this is one of those hidden secrets, and there's a lot of option buying information online. Not that it's good quality, but option writing is one of those gems which only a few selective people use it. To answer that question, in the US they have weekly options expiry dates. In UK we have limited option choices, but it's monthly. So the problem is you're limited to monthly income. So if you were to look at my 0.5% to 2%, that was split into 4 weeks. So 0.5% split by 4 weeks is about 0.15 or whatever, something like that. If you do that in the UK, clearly you're limiting yourself to that 0.15 to. So then in the UK you'll be doing that. The other problem with the UK is that the choice, as you rightly pointed out. So ideally, the US seems to be a great market for this, and it's just there are two sides to this option buying. So the one I've talked about is the professional side, or is the non-speculative side. The other side is the speculative, because there's a lot of speculative people in the market, so they're always buying options as opposed to writing. And because of that huge interest, because, you know, options can give you much scalable growth compared to just buying a stock, there is far more growth in these options on the US market than in the UK market. So you could trade them in the UK, you could trade them in Europe, but I think the biggest bang for the buck would be in the US.
Thank you for explaining that. Richard, another Richard, is the product tax-free?
The product, do you mean the product as in the options? Okay.
I think we're talking about options themselves. I don't think they're tax-free. Don't quote me. I'm not an expert in options.
No. Yeah, I mean, if you have capital gains tax, I mean, there will be capital gains tax applied on whatever income you get. So it's not it's not, you know, I'm not sure if you can. I think you can wrap it within ISA, but I think the things are so. I don't want to use the word underdeveloped here because the structure of the market is very different in the UK. But But you will be liable to pretty much the capital gains tax on any gains you have in the US. So on your income. But for the US folks, I think it's the same thing there as well.
Yeah, tax is a difficult thing for anybody to comment on. You know, have to sort of consult your tax advisor, but certainly in the realms of the spread betting, which everybody's familiar with in the UK, and probably has been something that most people have fallen into, as opposed to options trading, which always has the perception of being more complicated.
Yes.
Spread betting itself, if I'm correct, is actually not entirely tax-free if it is a primary source of income. Probably someone on the webinar will know better than I on that. But again, anything to do with tax, we always avoid giving out any advice, as we do with any financial product or system. We're not inciting anybody to buy or sell anything. Should one assign a stock is the strategy to sell? Sorry, Richard, I'm trying to should one is assigned a stock? If one is assigned a stock, is the strategy to sell it back to the markets as soon as possible?
No, I mean, you know, then we're going into this detailed discussion of, you know, why you decided, why you're buying that security in the first place, because there's a lot about sort of, you know, the whole strategy. So you essentially have a strategy for a portfolio. So if you get assigned, that's okay, because you decided to buy that security in the first place. So it's not a gamble. I mean, that's why the word risk aversive. So when we traded that NVIDIA, we wanted to acquire NVIDIA. When we did acquire, we simply we don't want to sell it above 105, but we want to receive that extra income which others don't receive. So just to let you know, I mean, this is so it is so kind of exclusive that in the UK you've simply got you've got two brokers who allow you to do options. So there is a clear distinction. This is not binary options. This is a different option. This is equity options. So the answer to that question is, if you get assigned, that's okay. You can still make money on that stock by writing covered calls. So it's perfectly fine.
Fantastic. Well, Tom, we are almost out of time. We have another presentation starting in 3 or 4 minutes' time. So unless there's any final questions for Tom at the moment, I think we'll say thank you very much indeed. And I think it's something we probably need to look at again, because I know that options are very much coming back into well, if fashion is the right word, but certainly the sort of the new guidelines on leveraged accounts, on spread betting companies and so forth, options are certainly becoming a viable alternative for one to get a sort of a leveraged position. So thank you. One last question before you go, Tom. However, if one kept a stock, would this not tie up a too large percentage of one's capital? This is again from Richard.
Sorry, can you repeat that question? I'm trying to understand the question.
Yeah, sorry. Richard said, however, if one kept a stock, would this not tie up too large a percentage of one's capital?
So it's a very it's an interesting question, because I think you're looking through almost as a money manager. So good question. Here, this is the beautiful thing about options. So when you have that position which is tied, so that let's say that position, whatever that position was, because you have the ability to write covered calls, so essentially you're not necessarily tying that capital, because you can still write covered calls. So you can write put options when you don't have any capital assigned. So that's fine, your capital is allocated, but once your capital is assigned, you can still write covered calls. So that's the beautiful thing. So back to your question about sort of how much money should one have, it really depends. Because this is a risk-aversive strategy, as long as you know what you're doing, you can, you know, money is there to be made money on top of money. So it depends what you do. But yes, ultimately, if your money is not assigned, you're writing put options. If your money is assigned, you're writing covered call options. And that's the beautiful thing about this strategy. Just want to add one more thing, Simon, because if you want to book anything on the website, which is marketsflow.com, you won't be able to use this discount. So you need to send me an email, and I'll then I'll give you the voucher which you can use for the discount. So just want to add that there.
Fantastic. Okay. Well, shall we do that now? Or do you want to tell people what that voucher is, so that we could do
sorry.
that?
You just need to send me an email at tom@marketsflow.com, and I'll send you the voucher. Sorry.
Fantastic.
Add another layer.
Tom at MarketsFlow. I think I've put that in the chat box, but we'll copy it again just in case anybody missed it. There it is. Okay, fantastic. Tom, it's been a pleasure to have you on. Thank you very much indeed for coming and tackling the somewhat people sometimes just say, oh, options, it's too complicated for me, but it really is worth having a look at. I'm hearing more and more about people trading options again nowadays, so thank you for coming on and joining us for that. I will take the presenter role back from you, if I may.
Thank you.
Thank you very much again. Good luck. Thank you. There we go. Tom Nash, CEO of MarketsFlow.com. Okay, we are moving swiftly along. We're just coming up to 1:45. We're almost exactly on time, which I like. Thank you for joining us, everybody that's here. Round the clock trader.